Right now, the global economy is being completely rewritten by a massive, undeniable clash. On one side, you have the unstoppable force of tech-driven economic resilience. On the other, systemic, rapid geopolitical fragmentation. It's literally changing the rules of global trade and investment in real time.
Let's put a number on that tech resilience. $800 billion. That's the estimated AI infrastructure capex boom we're seeing. It is almost single-handedly driving U.S. economic resilience and pushing equity markets to absolute record highs. We're talking about an unprecedented flood of investment pouring straight into data centers, advanced semiconductors, and the massive power grids needed to just keep this whole computational engine running.
But right across from that technological growth is a massive shadow network, a $4 trillion global illicit economy. It's staggering, really. This alternative market is fueled entirely by geopolitical instability, trade wars, and fractured supply chains that are basically handing bad actors the perfect blind spots to exploit.
So you have these two completely divergent forces pulling at the year. A soaring AI equity market slamming right into localized energy shocks and severe trade restrictions. It's this intense, constant tug-of-war between massive technological productivity gains and the really grounded physical realities of global conflict. And believe me, the intelligence community, risk analysts, and every major financial institution are watching this exact tension dictate market outcomes.
Now, just before we dive into the specific market projections driving all this, a really quick reminder that past performance is never a guarantee of future results. All investments carry inherent market, currency, and geopolitical risks, so definitely adapt these frameworks to your own strategic context.
All right, Section 1, AI boom meets energy shock. Let's look at how this unstoppable AI momentum is physically colliding with the harsh realities of global commodities. Take copper, for example. We recently saw a 16% jump, pushing it to nearly $12,000 a ton. And that's despite widespread global supply disruptions. It turns out the physical infrastructure needed for AI is just insatiable. You literally cannot build a trillion-dollar cloud computing network without the fundamental physical materials to conduct electricity and dissipate heat. So this creates a massive structural floor for base metals, totally independent of what the broader manufacturing sector is even doing.
Meanwhile, the energy market is balancing on a knife's edge. Morgan Stanley has set a baseline of $90 a barrel for oil. But if a severe geopolitical downside scenario hits, we could be looking at a massive volume shortage and an explosive $150 a barrel price shock. An event like that would instantly reignite global inflation, completely derail central bank rate cuts, and force companies to pass those surging logistical costs straight down to everyday consumers.
Section 2. Divergent paths of global growth. So, how does all this intense macroeconomic tension impact global